Hey everyone, welcome. I'm Wendy Jimenez, SMSF Specialist and Accountant, and I am so excited to share this explainer with you today. A lot of Australians assume they just don't have enough money in their super to make any real difference. They peek at their balance and think, well, I'm too far behind, why even bother? But I'm going to let you in on a little secret today. The truth is, people with relatively low to moderate balances often have the absolute greatest opportunities sitting right there waiting for them inside the super system. Look, it is completely understandable to feel kind of overwhelmed by superannuation. The rules constantly change, the jargon is super dense, and it's just so easy to toss it into the too hard basket. But I hear you, and we're going to flip that entirely into a positive right now. Inside the Aussie super system, there are these incredible hidden tools. They're basically opportunities built specifically to help you grow your wealth. Once you get the hang of them, you can absolutely take control and empower your retirement. So, here's our roadmap for today. We're going to cover the tax advantages, how to boost your super straight from your pay, leveraging family and government boosts, strategic timing, and finally, how to avoid those pesky common mistakes. All right, let's jump right into the first part of our roadmap, understanding exactly why super is such a tax-effective vehicle for your money. The whole reason super works so incredibly well really boils down to how it's taxed. When we're putting money in, we're basically looking at two main types of contributions. First up, we've got concessional, or before-tax contributions. This includes your employer's super guarantee and any salary sacrificing you do. The brilliant part here, these are generally taxed at a really low 15% inside the super fund. When you compare that 15% to your standard marginal tax rate on your regular income, which could easily be double that or even more, it's a massive advantage. Then on the flip side, we have non-concessional, or after-tax contributions. This is money straight from your take-home pay. Because you've already paid income tax on it, it's not hit with any additional tax when it goes into your super, as long as you don't exceed the limits. And speaking of limits, $30,000. That is a very important number to keep in your head. As of July 1, 2024, the concessional contributions cap is exactly $30,000 per financial year. This cap is there to manage just how much money you can funnel into this highly tax-effective environment every year. Keep in mind all your before-tax contributions, so both your employer's regular payments and your own salary sacrifice, they all pool together and count toward this $30,000 limit. Moving right along, let's look at how you can start boosting your supers directly from your everyday pay. Our very first big opportunity here is salary sacrifice. In practical terms, here's how it works. You simply make an agreement with your employer to redirect a slice of your before-tax income straight into your super fund. Because this money goes into super before the taxman even touches it, it can potentially drop your overall taxable income for the year. And honestly, the best part is you don't have to sacrifice huge chunks of your paycheck. Seriously, even redirecting just $20 a week can snowball into tens of thousands of dollars over your working life, all thanks to that low-tax compounding environment. Now, what if your employer doesn't do salary sacrifice, or maybe you're self-employed? Well, that brings us to personal deductible contributions. This is where you take your own after-tax money out of your bank account, put it into your super, and then you actually claim a tax deduction for it when tax time rolls around. It's essentially a magic trick that turns an after-tax contribution into a before-tax concessional contribution. But and listen, this is absolutely critical. You have to strictly play by the ATO's rules. You absolutely must provide a valid notice of intent form to your super fund, and you need to get their written acknowledgement before you lodge your tax return or start a pension. No exceptions. Okay, let's pivot to some really cool strategies involving your family and the government. Opportunity number 3 is the government co-contribution. And guys, this is a fantastic boost. It's designed specifically to give lower income earners a helping hand. If your income falls below a certain threshold and you make an eligible personal after-tax contribution to your super, the government might actually step in and chip in extra money to your account. It's literally a matching boost from the government. Just note, to be eligible, your total super balance on June 30th the previous year has to be under the general transfer balance cap. If you take those boxes, it's an incredibly powerful way to score a free kick for your retirement savings. Next up, we have spouse contributions. If your partner has a lower super balance or a lower income, you can actually choose to put money into their super account. Not only does this help boost their retirement stash, but if they meet the income rules, you, as the contributing spouse, might get a really nice tax offset on your own return. It's a win-win. There's also another awesome tool for couples called contribution splitting. This is where you can take a chunk of the concessional contributions you've made this year and transfer it straight over to your spouse's account. It's a fantastic strategy for balancing out your super accounts as a couple over the years. For both of these, just make sure you double-check those eligibility rules first, especially making sure your spouse hasn't blown past their own contribution caps.
Right, let's talk about timing, because knowing when to pull these levers is just as important as knowing what they are.
$500,000. This specific total super balance threshold is super important. The ATO checks your total super balance, or TSB for short, at the end of every financial year, on June 30. If your TSB is sitting at less than $500,000 at the end of the previous financial year, it basically hands you the keys to one of the most powerful timing strategies in the entire super system. And this perfectly illustrates that exact strategy, the carry-forward concessional contributions rule. Say you haven't been able to max out that $30,000 cap over the last few years because, life happens and funds were tight. Well, the ATO lets you carry forward the unused bits of your caps from up to 5 previous financial years. So if your total super balance was under that $500,000 mark on June 30, and you suddenly have a blockbuster income year, maybe you sold an asset or landed a massive promotion, you can tap into those accumulated unused caps. You can contribute way more than the standard $30,000 in the current year, which gives you a massive tax deduction right when you need it the absolute most. We also have a nifty timing trick for after-tax money known as the bring forward arrangement. This lets you bring forward future years of your non-concessional cap so you can drop a large lump sum into super right now. But notice how your ability to do this is tied directly to your total super balance from the previous June 30. Taking the 2026-27 limits as an example, if your balance was under $1.84 million, you could potentially bring forward 3 years of caps. That allows for a massive $390,000 contribution in one go. But as your balance gets higher, the amount you can bring forward shrinks down to 2 years, or eventually, nothing at all. So to wrap that up, your total super balance is essentially the master key here. It decides if you can use the carry-forward rules for before-tax money, it sets your bring-forward caps for after-tax money, it completely dictates your eligibility for the government co-contribution, and it impacts whether you can get that spouse tax offset. Honestly, it is absolutely vital that you keep an eye on this every year. It's super easy to do. Just log into your ATO online services through MyGov and check it out. Okay, we are on the home stretch. Let's talk about the pitfalls, because there are a few common mistakes you definitely want to avoid. Treating your super contribution caps like a single, bottomless bucket without really getting the rules, yeah, that can cost you. Here are the big mistakes I see all the time. First, accidentally blowing past your concessional or non-concessional caps. Second, assuming all money going in is treated exactly the same. As we've covered, before tax and after tax are totally different beasts. Third, forgetting to lodge that notice of intent form on time when you want to claim a personal tax deduction. Fourth, leaving government money on the table simply because you didn't check your total super balance. And lastly, putting in just a tiny bit too much after-tax money and unintentionally triggering the bring forward rule, which completely locks up your caps for the next 2 years. Just to show you why this matters, if you mess up and exceed your concessional cap, those excess contributions get bounced right back into your personal assessable income for that year. You will get taxed on them at your normal, higher marginal types rate. Now, the ATO does throw you a bone with a 15% tax offset to make up for the tax the Superfund already paid, but trust me, it's a headache you want to avoid. Tracking your contributions across all your jobs and Superfunds is just absolutely crucial. I really want to leave you with this thought today. Building retirement wealth is rarely about making one huge, dramatic contribution the day before you retire. It's usually about understanding the rules, starting right where you are today, and taking advantage of these opportunities consistently over time. Small, regular actions create the most magnificent impact when you just give them time to grow. So, now that we've mapped out this empowerment roadmap together, I've got to ask, which of these hidden super tools are you going to explore first? Are you going to look into salary sacrificing just a few extra dollars a week? Or maybe log in and check your total super balance to see if you can carry forward some unused caps? The opportunity is right there waiting for you. And finally, just before we wrap up, a quick general advice warning. Keep in mind that everything we talked about today is general educational information only. It doesn't take into account your personal circumstances, your financial situation, or your specific needs. Superannuation rules can be a bit of a maze, right? So before making any big financial decisions, definitely consider seeking advice from an appropriately licensed financial advisor, a registered tax agent, or a qualified professional. Thank you so much for joining me for this explainer. And hey, here's to empowering your retirement.